I've got a cake to bake, haven't done that before. I've got a cake to bake, haven't done that before. The only problems don't seem to matter when you're always tired. Let it bake, bake that cake. Hello everyone, hello. You are someone and I'm someone else. And today we are going to be talking about the economics of investing in investment funds. We're going to be talking about Thomas Sowell in this book called Basic Economics. And we're going to talk about Bogle on mutual funds. New Perspectives for the Intelligent Investor. It's an economics investment kind of book. So what I'm gonna say, it's gonna be pretty controversial, but a lot of people seem to think that actively managed funds like Thomas Sowell, he says 55% beat index funds. However, I completely disagree. I agree more with this book. And I'm going to say why. Right? When you think about the rules of arithmetic in investing, why you should listen to John Bogle over Thomas Sowell. Man, I'm jumping around today. I'm crazy. Whatever, right? The rules of arithmetic, John Bogle explains very clearly in this book and in all of the other books. This is the first book he ever wrote, by the way. But in John Bogle, Bogle on mutual funds, I'm sorry. There is John Bogle on mutual funds as well. It's another book he wrote. We're not going to talk about that book today because I don't have it on me. But if I had it, it's probably a little bit bigger than this book. But I have Bogle on mutual funds, which is the older version, I guess, of John Bogle on mutual funds. But like Basic Economics, his statistic is 55%. I don't know where he gets it. I forgot where he sourced it from. But he says 55% beat the index fund. Now, I don't agree, or beat the index. I don't really agree, because when you think about it, there's taxes and there's fees. You're buying an actively managed fund, you could be beating it in terms of equity or whatever, right? Think about it like that. You could beat it. But I just don't think, here's why I don't think you're going to be beating the index, right? Because there's taxes. Whenever an investor in your mutual fund sells something, it's a taxable event. Index funds only have one taxable event a year. What do you think active managed funds? Probably like 6 months a year they're selling stocks. Maybe less than that. There's a lot of feverish activity, especially in Bogle and mutual funds. He talks way more in detail about this than Basic Economics. And you could tell that Thomas Sowell, he's not a finance guy. He's a very good economist, but he's not finance. And so people don't seem to understand the difference between somebody who's in finance, like John Bogle, and somebody who is a basic economist like Thomas Sowell. Right? When you think about it, John Bogle is an investment economist. He's not a normal economist in any way, shape, or form. Thomas Sowell is an economist. He specializes in the resources of alternative uses. John Bogle talks about, okay, how do you maximize those resources when you're investing in a public market or a private fund, for that matter, in terms of his company with his privately held index funds that hold public stocks. So in that regard, it's a mix between public and private with Vanguard. I mean, Vanguard's open to the public, but it is a private company. You can't just buy and sell it on the open market. It's a closed-ended fund. Well, kind of closed in terms of like, you know, it's only on the website. You can't buy a Vanguard fund unless you're buying it through a 401k through your employer, right? But with, you know, that's the thing is like, whatever. I don't know the difference between a public, super public fund would be like an ETF, exchange trade fund, be traded on the stock market. Anyway, that's besides the point. I'm getting ahead of myself with the with the structure of funds. Basically, Thomas Sowell, you can tell that he lacks finance knowledge, even in his Basic Economics book. Don't listen to Thomas Sowell on investing, even though he's a fantastically smart person. And I do think that he does talk about delayed gratification. And he says that there's a risk with delayed gratification. I totally agree with him. And there's always going to be a risk because there's always willing to be a government that's willing to take your money, whether it be the American government or some other government. They want that money that is being held in an account because that's money they can confiscate and they can use for things that they seem more useful than you. You saving your money for your future, that's not important to them compared to what they want to do with your money. So, and people always say like, oh, they won't do that. No, they'll have an amendment. They'll do it. Or they'll like call it constitutional under the courts like they did with eminent domain. They'll totally do it. I totally think they will. Anyway, it's besides the point. I do think that Thomas Sowell is a bit more cynical than John Bogle. John Bogle, if you follow his strategy, though, you will be relatively okay. They can still confiscate things. If they confiscate your equity, that means that we are living in a very immoral society. And they will start doing it, I think, in the next 20 years. They will start confiscating equity, but they haven't done it just yet. They only confiscate the percentage of dividends. They confiscate about 25, about 15% of your dividends federally, and then the state can take some of it too. But generally, the federal government will tax about 15%, and if you hold it short term, it's 20%. Whatever. We're, with the capital gains, I know it's 20%, and it's for short term capital gains. It's 15%. Same thing with dividends. Dividends are technically seen as short term capital gains. But anytime you get a dividend, and this is another thing I think that Thomas Sowell doesn't talk about that much. Anytime there's an income transfer, there's a tax. I don't know if he talks about it too much, but I know John Bogle doesn't talk about it as much either. But I know that I have really been paying attention to how taxes work in dividends. And now one thing is, if you get a stock that pays a dividend higher than what it's retaining in its earnings, you are losing out on compounding of the stock price. And why would you do that? Why would you create a bunch of taxable events in between you buying and selling the stock? It makes absolutely no sense. So in my opinion, you should try your best to find a stock that's paying a dividend because it shows that it cares about its shareholders. But I mean, an index fund, honestly, just buy an index fund. You don't have to worry about that kind of stuff. But because an index will always pay dividends for the most part, unless every stock decides they're going to retain their earnings. And at that point, maybe most investors will pull out of the index and maybe it would make it cheaper or more expensive. Who knows? I'm getting ahead of myself on the economics of... But, like, that's the thing. I don't give investing advice. But if I was going to have to listen to one or the other on investing, John Bogle is way better to listen to than Thomas Sowell. And people seem to be misled on economics versus finance. Thomas Sowell is amazing. On chapter 3 of this book is the best chapter I've ever read. Period. I think it's better than almost anything John Bogle's ever written. But I don't think it will help you. It will help you, like, think differently about the world. But it won't help you individually. It will help you more prospectively overall how the world works. Chapter 3 of this book. This book, or books after, I don't recommend this book actually, but because it's too old really. These are numbers from the 90s, but it was the first study done on the taxation of mutual funds ever. It's the first study done on the taxation of mutual funds. Which is like, it's amazing to me. This was the first study done, and mutual funds have been around for over 100 years. Like, since this book was published, or when this book was published. And so that's what I love about this book. This book revolutionized how people think. And while I don't recommend you get this book, because I recommend other books from John Bogle, I think that you should be listening to John Bogle over Thomas Sowell. Anyway, that was what I was going to talk about today, was just the difference between investing economics and like an economist, like a Chicago school economist like Thomas Sowell, a classic Chicago economist. They're two different types of economists, and people seem to confuse the difference between investing and finance versus economics. They seem to confuse the two. And every time like I buy like an economics book, they're like, "Are you buying an investing book, a finance book?" I'm like, "No. Economics has a completely different definition from investment. Economics is like the economy is related to investing, sure, with like the definition of economics is alternative uses, resources for the population. Investing is how do I manage my resources invested wisely to get back more in the future, kind of. And so in that regard, investment is one part of the economy. There's time, interest, and investment. technically there's 3 parts of the economy. Investment's only one. And so Thomas Sowell doesn't talk about investing that much because he doesn't specialize in it. He talks more about time and interest. He's really good at time and interest. He's not good at investing. And so that's everybody seems to know that. Now, is he a good investor? I have no idea. He's still alive. He's 92 years old. I'm sure he has a pension of some kind. And he always talks about how the academia has been poor at mismanaging their finances. You see how corrupt academia is, and they keep spending money on things they don't necessarily need, and their pension systems are going broke, and Thomas Sowell brings that up all the time. The Visions of the Anointed is he's so good at explaining what's going on in terms of like the academia because he lives in academia, but outside academia, Thomas Sowell doesn't really know a whole lot. He's not a finance guy. John Bogle, he was in academia for a long time, but he also stayed in the mutual fund business, which is a private business. He was able to license himself in Pennsylvania and then the rest of the country. So in that regard, I would listen to somebody in the private sector more than somebody in the public sector, like in university, which is, universities, they may be private or public, but they get tax exemptions. There's a lot of support. There's pension systems, a lot more support than the private sector. Even though, John Bogle did create an entire pension system with his company. So I guess you could regard him as kind of a public thing too. Anyway, that's besides the point. The difference between public and private is so complicated. I don't really have time to do to go into that. Man, this was such a weird video. I'm so sorry, guys. But anyway, you are someone, I'm someone else. I wanted to talk about the difference between investing and economics. I hope I explained it well enough. I don't ever want to give people certain advice because advice is different for everyone. But I do think that you should look into both of the authors and see why they're different and why you can't not confuse investing versus economics. You just cannot. I think that is a logical flaw that people do not understand. Hopefully you do, though. Goodbye, everyone.